This is why over the last couple of weeks, we talked about reducing risk in our portfolio. We took profits and stuff. We added to some defensive names in the portfolio because we were starting to get concerned about both the length of this advance as well as the very low volatility we were having. And then we talked about the negative divergence in breadth as well as the negative divergence in relative strength, all signaling that we were about to have a corrective phase. So that's why we had reduced risk and rebalanced some positions. So we're now in that phase. But overall, despite those little dips, you probably want to be buying dip, and this one included, you probably want to buy these dips going into year end.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of the week for another weekly market recap featuring my good friend, the entomological portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing fine. How are you today?
I am doing great. It's great to be back on the program. Hope all's well.
Yes, everything's doing very well. So yeah, good to be here.
All right. Well, I went with entomological, which maybe the scientists in the audience will know that stands for of and having to do with insects. And we're hearing a lot of talk about cockroaches right now in the economy and the financial system. So we'll get to that in a bit. A couple quick things though. So folks, if you're watching this video the day it's going live, if you're watching it when it goes live, we are just starting in parallel to this, the Thoughtful Money Fall Online Conference. And actually, if you still want to watch, you can still jump in early on in the conference. Just go to thoughtfulmoney.com/conference, buy your ticket. You'll get immediate access into the live event. It's a 10-hour event. I think in fact, it might be a 10+ hour event. I got to figure out how to shave some time off. But folks, it is going to be fantastic. Just a tremendous faculty. Could not be more timely given what's going on in the world and in the markets right now. If you're watching this later than that, if you go to that same URL, thoughtfulmoney.com/conference, you can purchase the full replay of the event after it's done. You'll get everything. You'll get all the presentations, all the live Q&A, all the archives from the live chat, and all the resources that were shared by the faculty members. So anyways, that's going on right now in parallel. Lance, I'm going to sleep for like 3 days straight after this. As you can probably. I also want to say last week while you were busy with your wife and Michael Leibowitz sat in for you, we had to record a day early because of my schedule. And I made just the huge karmic error of saying, hey, Mike, well, we're recording here on Thursday, so folks, we're going to be missing one day of the week. Hopefully nothing happens in the markets on Friday. And the markets heard that and said, hey, buddy, here, hold my beer.
Yeah, exactly.
I think we had a 2% down day in the S&P, one of the biggest drops of the year. So anyways, there's lots to talk about this week.
Yeah, absolutely. So go ahead.
Okay, well, I'm trying to figure out where do we start, right? Do we start with, cockroaches in the credit markets? Do we start with the whole trade war? Are we in a trade war? Aren't we in a trade war with China roller coaster that President Trump has had the markets on? Or do we talk about the quote unquote debasement trade, which the financial media is talking about like it's this brand new thing, which of course has been going on for decades. So where do you want to start?
You pick it, don't care.
Don't care. Okay. Well, all right. Why don't we talk about the cockroaches?
Okay.
So you and I think you and I know Michael and I talked about it last week, but we have seen some bodies float to the surface. Folks are probably getting sick of me using this analogy, but I think it's a good one, where we had some companies that had taken out obviously more debt than they could handle through the private credit market. And in the private credit market, as you and I have talked about for a long time, Lance, it's really grown a lot. It sort of exploded in size over the past bunch of years, 5 years or so. A question we've asked ourselves is it ever going to start exploding in terms of bad debts going bad? Because we don't really know the quality of the debt that the loans that are being made in this space, right? It's not regulated the way that the banking system is. We've all sort of been crossing our fingers and saying, hey, hopefully these guys are making sane loans that make sense. But we won't really know until quote unquote the bodies start floating to the surface. And so we had TriColor, we had First Brands. Now those were sort of in the automotive sector. So, maybe folks have been saying, well, those are kind of one-offs and maybe that's just contained to the automotive sector. But now we're starting to see some regional banks really start to struggle here. And again, Jamie Dimon said, sort of referred to these companies as cockroaches. And when you see a cockroach on the kitchen floor, you don't have just one. So how big of a deal is this at this point, do you think?
It's not. I mean, it's important to pay attention to, just because anytime you have any type of defaults like that go on, there's always concern that, well, there's more out there, and there probably is. But, this started with, the tricolor issue, then it went to first signal. And, we saw these, kind of defaults being done in some of these private credit markets. And actually, we were just talking about this morning. Mark Cuban recently just backed a firm. I believe they're in Dallas. And what this firm does is they basically loan money to poor credit borrowers against the equity in their automobile. So think about that for a moment. I have a very low credit score, which means I probably took out a subprime auto loan to buy a car of some sort. I've made payments on it up to this point, and then maybe I've built up a little bit of equity in this. So now I'm going to take money out of my car, which is a depreciating asset. So this is just the type of environment that we've worked ourselves into. So it's not surprising that you're seeing some of these things blow up. But the immediate concern is like, oh my gosh, this is going to be another Silicon Valley Bank situation. That was very different. Silicon Valley Bank was impacted across their entire collateral all at one time, and became under collateralized as a bank, and that's what caused the default of Silicon Valley Bank. And that kind of spread through a couple of other regionals, and of course, the Federal Reserve stepped in with their kind of their bank bailout fund at that point, and stabilized that situation. This is different in the standpoint that this is not affecting the entire collateral of the bank. Yes, it's hitting pockets of collateral at the bank. So in other words, yes, they are definitely having some issues with some of the collateral that they own, for sure, no doubt about that. But it's not at this point, it's not a contagion across the entirety of the asset scope. It's also not, and of course, the other side of this is like, oh my gosh, this is the next subprime loan crisis. Not nearly to the magnitude. You were talking hundreds of billions of dollars worth of subprime credit. You're talking just of, several billion of this type of credit, potentially having trouble. So again, the point is, don't want to, it's certainly worth paying attention to. And if you own regional banks, it's certainly making sure that, the bank that you own is not grossly impacted. In other words, they've got a lot of exposure to this
Mhm.
debt. So make sure that the banks that you own on the regional side are good banks. And like we went through and did some credit risk adjustments in our bond portfolios. We had some Jeffrey bonds about 2 weeks ago, right when the kind of the tricolor situation came up. We went in and sold all the bonds that we had on regional banks that might be exposed to that area. And so we cleaned all that risk off our table before that accelerated. So again, that's the kind of actions you want to take here, but I wouldn't extrapolate this out into something being a lot bigger is going to bring down the whole credit market at one time.
Yeah, agreed. Although let's just put a caveat in at this point, right? Because we don't know the extent at
Mhm.
which there may be a contagion here, but right now it seems, hate to use the word contained because that's what they used to run subprime.
Right.
Um, but maybe the better analogy here to switch insects is it's like a couple of termites, right? You're like,
Yeah.
okay, my house has got termites. Doesn't necessarily mean the foundation has been riddled and the house is a teardown. It might mean, hey, early on, you can pay a good fumigator to come in and address the problem. We just don't
Mhm.
necessarily know yet, but we're not seeing signs that the house is in any real mortal danger yet. Um,
Yeah.
okay, but Lance, so you talk about Mark Cuban's investment there.
Right.
Um, something similar I saw recently that PayPal has their own buy now, pay later service that they
Right.
built. And I read recently that they basically sold the book of the loans to another company, right? Which
Hmm.
kind of suggests, that they're like, we know how bad this thing is,
Yeah.
and we want to get the exposure out of here. So my question is, we've railed about buy now, pay later, and the fact that, people are literally using it to buy their dinner, right?
Yeah.
Um, so that plus Cuban, lending to a subprime auto, uh, market of people who have this depreciating asset who have already demonstrated, weak credit, credit integrity. Um, to me, those just sound like really late stage, like late cycle stage developments where everybody is trying to come up with the next innovation just to squeeze a little more juice out of the lemon. But when you kind of look at it from a distance, you're like, that seems really ridiculously risky.
Yeah, no, I mean, you have to imagine that buy now, pay later. And again, there's companies like Affirm and Klarna that are doing this. And again, in the original concept of it, it made some sense, right? Because it's like, okay, I want to finance a couch. And so I can go buy this on buy now, pay later, and I can finance this over 4 payments and I can get the couch for my apartment, right? So that kind of made some sense. But to your point, it has now turned into, hey, I'm going to use this to go to McDonald's or to go to, Walmart and buy groceries, whatever it is. So, we've just created another level of credit accumulation for the least creditworthy borrowers. And, that does certainly raise a risk. And if you take a look at the buy now, pay later kind of scope, nobody knows exactly how much is out there because it's not on balance sheets and a lot of things like that. We don't have a like when we track federal debt, we know to the penny exactly how much federal debt is outstanding. We don't have that kind of tracking for buy now pay later, at least not right now.
Yeah, which
It's
is why
just
this feels late stage to me, because that's one of the things when it blows up, you're like, ah, we probably should have had more
should have,
visibility.
yeah, but it's estimated to be around 560 billion, right? So it's
Not
not
nothing.
small. It ain't nothing. It's half a trillion bucks. Again, when you look at the subprime crisis, that was around 1.3 trillion. So again, this is about half the size of the subprime crisis. Not saying that ain't nothing, but it's certainly there. And it's also not assuming that, you got to also remember the problem with the subprime crisis was really twofold. It really wasn't the subprime mortgages that were the problem. The problem was is that we took those subprime mortgages, then we split off the principal and the interest, then we recollateralized those, or we
Right.
repackaged those on top of something else, and we sold the derivatives on those options. And we're not doing that with the buy now, pay later market. And the other thing with the financial crisis was is that really that situation would have worked itself out in probably a more normalized bear market. Maybe the markets were down 20, 25%. Bear Stearns get sold off at $2 a share, $3 a share. Maybe, we see Goldman Sachs on the ropes, or something like that. And maybe they need a bit of a bank bailout. But what really caused the financial crisis was when they forced Lehman into bankruptcy. That caused a complete credit freeze, right? And that's what really, if you look at the bear market of 2008, about 40% of it occurred right after the bankruptcy of Lehman because it simply just froze the credit markets. So, that's the one bit of context. And when everybody relates everything back to something happens, it's like, oh, the AI bubble is just like 1999. Big differences. This is happening because this happened before. Big differences this time. And same thing with the subprime crisis. Be careful about just going back and saying, oh, this is going to evolve the same way. The environment's very different, and we're not going to shut down a major bank that freezes counterparty risk across the board. So now, will the credit issue cause a problem in the financial markets? Absolutely. Could we lose some regional banks over it? Absolutely. This is why it's just going to be really important about where you're allocating your risk in your portfolio.
Okay, so that's it's a challenge, and maybe I'll just ask you the question directly. So,
Mhm.
so as a capital manager, you're like, all right, we see some of these cockroaches. Don't necessarily think that this is anything like a Lehman moment yet, but we just don't know what the contagion is here. What do you do? Do you take some initial steps? It sort of sounds like you did, where you sold
Yeah.
off your exposure to regional banks. Um,
Well, no, no, we reduced our credit exposure to regional banks. So we have one position in our portfolio that's a regional. It's just Truist Financial. Balance sheets are great, cash flows are great. Stock's been under a little bit of pressure with this, obviously, as you would expect, and probably at some point here I'll look to accumulate some more into that position. But the rest of our stuff is in the financial side is J.P. Morgan, Goldman Sachs, BlackRock. That even if you look at the size of a J.P. Morgan or a Goldman Sachs, a 500 if they absorb the entirety of the buy now pay later at 500 billion, that would be a huge deal. But that's even survivable for them. But what I don't want to own is the bonds. And so that's why, for instance, as soon as we saw any risk show up with the TriColor situation, we immediately went through our credit book and started reducing any exposure that we had to banks that are related potentially to that area of risk. So we just sold the bonds entirely. And again, the bonds were still trading at par, so it was no big impact to portfolios, but just removing that risk was the step you want to take at that point.
okay. forgive me, this is kind of a naive question, but I think it's relevant in case we start seeing more contagion here, which
Yeah.
is, let's say you own a regional, you know, you own a security of a regional bank,
Uh-huh.
and you're a little bit worried. I would think, all things being
No.
equal, you would want to sell the equity in that bank faster
Mhm.
than you'd want to sell the bonds in the bank, because the bonds are just an existential risk, right? It's
Sure.
just like, hey, I still get paid unless this thing goes belly up. I mean, we could go through a scare period or a period where the bank gets beat up a bit, but I'm still going to get paid if I hold the bond.
Mhm.
Equity, you might be like, all right, I don't want to hold that because that could really get
Yeah.
wild.
No, no, and if you have a lot of again, we have a out of an entirety of our portfolios, we have probably a 0.5% exposure to one bank, right? So even if the bank goes to zero, it has almost zero impact across the balance sheet of the books. So, but yeah, if you've got a lot of exposure to regional banks, you probably want to reduce some exposure here, at least until you get through this period and understand what you're dealing with.
Okay. All right. Well, so let's move to the next sort of risk management thing that I think has
Mhm.
probably made the past week or so challenging for you. So what caused the markets to nosedive last Friday was a Trump tweet, or what do you call it, a truth that he issued on Truth Social, basically talking tough to China. And literally since then, it's been every day or two kind of a, no, we're friends again. Oh wait, no, we're not, and it just keeps going back and forth. That's going to be a little bit hard to be a capital manager, and just in the way that it kind of wangs around the markets. Even though I'm guessing, Lance, you're going to say that's pretty much noise. We should all pretty much ignore. But
Yeah, pretty much ignore it.
okay, so you're not making any changes to your portfolio based upon the will they won't they get into a worse trade war between U.S. and China?
No, no, because again, right now, and as we saw today, right? I mean, as soon as the market takes a little bit of a hit, he turns around and reverses his position. So, headline this morning, Trump says that tariffs against China aren't sustainable. So, markets immediately kind of rallied back off that news. At the end of the day, all I care about is what the market's saying. If you will do a better service to your viewers and to if you're managing your own portfolio is to turn the television off. Stop looking at headlines because headlines don't mean anything. At the end of the day, it's great for narratives. And again, we have just a ton of narratives running through the markets, whether it relates to a variety of asset classes. There's some narrative, and if an asset's going up and people are long that asset, they create a narrative or to rationalize why they own that underlying asset, regardless of whether it's a true narrative or not. And
Correct.
in most cases, these narratives aren't even reality. So if you'll just pay attention to what the market's telling you, in other words, this is why we always look at technical analysis every week. That's all you're really concerned about. The market broke the 20-day moving average this past week, which was notable. Certainly makes you wake up because that's been the running trend line now since the April lows.
Hey, I'm going to interrupt you because can you just pull up the chart while you're saying this? If we're going to
Sure.
talk about the moving averages, let's actually show people.
Yeah. So yeah, here's the chart right here. So a couple of things going on the chart. I actually tweeted this out this morning on my X. So if you every day I post some stuff on X about this at Lance Roberts, and I tweeted this chart out this morning. And I don't, what do you call an X these days? You can't call it a tweet anymore. So because it's not Twitter,
They call
I
it a
posted an
post.
X. What's it
They call
called?
it a post.
It's just a post. Okay,
Yeah.
I posted this morning. It was better. I like it better when I can say I tweeted it, right? So
Mhm.
I think we should go back. But anyway, that's me. But anyway, I posted this on X this morning. And so the red line is the 20-day moving average. The blue line is the 50-day, and the green line is the 100-day moving average. The black line in the back is the VIX, and you can just see here that over the last few days, volatility has picked up, and that's important to pay attention to. But what's important is again is that if you go back to really kind of the April lows, the market when it rallied back above the 20-day moving average, that became the point of support for this entire 30% rally from the lows. So every time the market would rally, you get two deviated above the 20-day, you get overbought, you get a pullback to the 20-day, it rallies again. And it was kind of the stair step higher, so you'd rally up, get deviated from the 20-day, correct back to it, or maybe slightly below it, then immediately regain it and then move back higher. So last Friday, we cracked that 20-day moving average with some significant volume and a big decline. We were down 2.71% on Friday, and we came right to the 50-day moving average. So again, held support at the next critical level of support. Retail buyers stepped in, bought the dip. rallied the market back to the 20-day, failed there, came back down, retested the 50 on Tuesday, bounced off of the 50 on Tuesday morning and rallied back during the day. And then on Wednesday, got above the 20-day moving average, failed on Thursday. And now Friday morning, we're kind of, now again, Adam and I are recording Friday morning, so it's a bit early, but markets are positive right now, just a little bit. But we're trading below that 20 days. So this is the longest span that we have now spent since going back to the April lows below the 20-day moving average. But so that tells you there's certainly some stress in the markets that's worth paying attention to. And again, this is why over the last couple of weeks, we talked about reducing risk in our portfolio. We took profits and stuff. We added to some defensive names in the portfolio. We went through those previously because we were starting to get concerned about both the length of this advance as well as the very low volatility we were having. And then we talked about the negative divergence in breadth as well as the negative divergence in relative strength, all signaling that we were about to have a corrective phase. So that's why we had reduced risk and rebalanced some positions. So we're now in that phase. But right now, despite all these headlines, all the market's done is come down to the 50-day moving average. We're working off that previous overbought condition. Markets are still holding a good bullish trend from the lows, so we haven't really violated anything important here. So as long as we really hold above the 50 into next week, then we're okay, and the markets will likely probably flop around here some more. And then this weekend's newsletter, which I'll post tomorrow at realinvestmentadvice.com, is talking about the 3 reasons for a year-end rally and why the market should rally into year-end, and that's primarily because of earnings, buybacks, and portfolio positioning. And we're just into that time of the year. So November, December tend to be fairly strong months for the markets. And you're having about $7 billion a day in corporate buybacks starting at the end of this month to help support markets through year end. So I wouldn't really, now it doesn't mean you're going to go straight up into year end and we could just be wind up, marginally higher than we are right now by year end. But the odds are that the markets will be higher than lower between now and then. So, but again, it doesn't mean you can't have, we normally have a correction in the first 2 weeks of December as mutual funds and do their annual distributions of capital gains, interest, and income. So you typically get a bit of a pullback. Could have a little bit of a pullback in early November heading into the Thanksgiving holidays, just gets a little bit light trading. Those are kind of seasonal normalities. But overall, despite those little dips, you probably want to be buying dip, and this one included, you probably want to buy these dips going into year end.
All right. And I think we talked about this, Lance. Again, I can't remember if it was with you or it was last week with Michael, but I interviewed Mark Newton, who is Tom Lee's research partner there at Fundstrat. And he gave his forecast for the rest of the year and said he thought there was a high probability that there would be some correction, or I want to use the official term correction because what people think like 20%, some sort of pullback, 5%, maybe 10% in October, first half of November. And then he said, if it happens, he's going to use it as a buying opportunity, expecting a similar year-end rally like you just mentioned. So seems like you and Mark are seeing the same things right now. What is interesting, Lance, is, sorry, you want to comment on that?
No, that's right. I mean, look, as I said, seasonality wise, and there's some driving factors of the markets between now and the end of the year that you certainly want to pay attention to. Again, just there's a ton of money that comes into the markets in the last 2 months of the year, which typically tends to drive markets higher. But that doesn't mean that you can't have a 5 to 7% correction. I was talking about this a couple of weeks ago. And then of course, actually I was talking about it on Wednesday of last week. And then of course, Friday we had that 2% decline in one day, almost 3% in a day. So, they can come very quick, and, a retracement back to the 100-day moving average, as we were talking about earlier, that would be about a 7% correction. So again, that's not that big of a deal. It's going to feel a lot worse because this market's had no volatility and the market just goes up every day. I just throw money at any asset class. It goes up every day. It doesn't matter. Why worry about risk when I can buy Nvidia. It goes up every day. I buy a Bitcoin. It goes up every day, blah, blah, blah. It's great. But what that means is that when you do introduce volatility and you do have a pullback of normality, 3, 5, 7%, it's going to feel like a 20% decline. It's going to be like, oh my God, what's going on here? Is the world coming to an end? Is the AI trade over? But that'll be what happened. But that'll happen in every asset class. You're going to have fairly substantial drawdowns that are perfectly normal just to reset overbought conditions and give you a good buying opportunity to add back to that asset class. But again, when it occurs, what'll happen is, and this is today's article that I posted on the website talking about investing in a zero risk environment. What happens is we just bring in all those psychological biases on the way up. We start coming up with all these rationalizations about why a particular asset class is going up, even though that rationalization has no basis in reality. But that's how we justify overpaying for the asset. And then on the decline, we do exactly the opposite. Is now we rationalize why it'll never go up again, and so we have to sell everything. So it's just important, and that's we go through all the rules and psychology of how that works in today's article. But that's what's going to happen in markets. You just need to be aware of that and understand that those opportunities, at least for right now, are going to be more buying opportunities than they are selling opportunities.
Okay, so all right, how do you marry those two then? Because I was going to ask you about this new piece. Um, they're buying opportunities, but they're buying opportunities in an environment where investors are assuming there's zero risk,
Right,
right? And making up, inventing any rationale for why their assets going higher and they're going to buy more of it, right?
right, right.
So at what point as a capital manager do you say, all right, at some point this upward trajectory is going to reverse because people are just buying blindly?
Right. And it's going to. And you're going to lose the market. You're not going to get out right at the top of the market. But that's when this is when we go back to paying attention to the technicals. If you start breaking down important levels of support. We broke the 20. We haven't gotten back above it yet. So normally when you break a good moving average like the 20, we did it early this week on Tuesday. And then, by Friday, we haven't gotten back above it yet. So again, now there's starting to be, we didn't immediately reverse that break and negate it, right? So we've now spent a week below that moving average. And so that's starting to build some significance. We won't pay attention to that. The 50-day is holding for right now. But if we break that and then fail to get back above it, now that's kind of the second warning sign. So the thing is that what technicals will tell you is, and this is what we were saying earlier, is like just set aside all these narratives and headlines and everything everybody gets all wrapped up about. Just set all that noise aside because that's all it is. Let the market tell you what it's doing, and they'll tell you. So as you break these important levels of support, you know you'll have these indicators that say, okay, hey, you need to start reducing some risk. And this time is now different than it was previously because where we were buying the dips previously is not working now. And where sellers were showing up before to buy stuff, they're no longer there. And so, this is, there's an old saying that sellers live higher, buyers live lower. And at some point, buyers are going to go, yeah, I'm going to buy that. I'll buy whatever asset it is you want, but I'm going to buy it 20% lower than where it is right now.
Right.
And that's where buyers are going to be. But again, the market will tell you when that shift in psychology in the markets is happening and gives you plenty of time to start exiting positions, reducing risk, those type of things. Markets, the big concern, and I've heard this from a lot of people, is like, oh, the market's going to crash by 50%. Okay, great. It's going to crash by 50%. You're not going to wake up tomorrow morning and the market's down 50%, right? It may be down 5% tomorrow and you're going to take a 5% loss. But it won't matter what asset class you're in. A 50% correction is completely normal. It happens. Mean reversions happen, particularly in these type of markets, but it's not going to happen overnight.
Right.
And it's going to happen.
Unless there's a Lehman moment, but those are
No,
so
even
low
with Lehman.
probability tail
No,
risks.
no, no, no. The 50% correction during the subprime crisis took 9 months. Actually, it took almost a full year. It started in March of 2020, 2008, and it didn't complete until March of 2009. That was the 50% drawdown,
Yeah, you're right. You're right. Yeah. But I
right?
mean, but
So
your point, there was a lot that followed Lehman, but it wasn't the whole dip. Yeah.
well, no, and Lehman was in the middle. The market, so that's a great example. It's a fantastic example of exactly what we're talking about. If you go back and look at a chart of 2008, the market peaked in about June, and we were forming a head and shoulders pattern going into the month of June. And in June, July, we broke the neckline of that head and shoulders pattern. Then the market started to decline very normally. We rallied, we broke the neckline and rallied back up to it and failed. Great opportunity to get out of the market at that point. You're only down maybe 5% from the peak at that juncture. Then the market started declining, in August, really in late July and August, the market started working itself lower. And then on September the 18th, Lehman gets forced into bankruptcy, and then the market cracks, and you're down like 10% in the function of about a week and a half. So that was about 40% of the entire decline of the 2008 crisis occurred right after Lehman was forced in bankruptcy. But the market was telling you there was problems months before that happened, and the
Yeah.
market gave you several opportunities to get out of assets, which we did. We had shifted almost entirely into treasuries before Lehman ever occurred. And because we were starting to watch the unwinding of what was going on with subprime, we were watching credit spreads start to blow out. I mean, there was all these signals that told you there was a problem. But we get as investors, we get so wrapped up in this idea that, oh my God, the market's going to crash 50%. I'm going to lose all my money. It's not going to happen overnight. So, it's just understand that we have to pay attention to markets. Most of these headlines and narratives are complete rubbish. You shouldn't pay attention to them. The technicals, the indicators like credit spreads, those type of things, those will tell you what the risk is in the markets and what you need to pay attention to in terms of your portfolio.
Okay. Yep. And this is again your sort of 3 month headlights that your
Yep.
technical analysis kind of tells you. It begins to tell you when there's some, you know, traffic cones and cautionary blinking lights on the highway. And to
Yeah.
be clear, you've maybe seen a few of them, right?
Yeah.
Which is what got you out of the regional bank there, made you lighten up. But nothing that you're saying, okay, this looks like, it's going to crack in the immediate near future.
Right.
I am going to ask you about credit spreads in just a minute.
Sure.
Um, let me ask you. Uh, I hesitate to bring this up because you're gonna go off on a rant about
Then
narratives
don't,
and how they
then don't
don't
bring it
matter.
up.
Yeah, no, you go off on a rant about narratives, and whatever you say, probably the
Yep.
majority of the people are going to say Lance doesn't know what he's talking about on this topic. But
Yep.
what are the technicals telling you right now about gold and silver? Because they have continued their massive run. The morning we are recording this, they're actually having a bit of a corrective day in the market. I think silver was down almost 4% the last time I looked at it. But silver is still above 50. Gold is still above 4,200 an ounce.
Mhm.
Just phenomenal runs this year, but phenomenal runs over the past couple of weeks. We knew technically they were getting super stretched from their moving averages. So I'm curious to see if what you're seeing in the data right now just says, hey, they were so above their moving averages or just potentially moving back to them, or if it's starting to tell you something even different.
Well, no, I mean it's not really saying anything different. I mean, gold is going to be a phenomenal short at some point, right? It's just that's just going to be a function of time. You're so deviated from like the 4-year moving average and the 5-year moving average. You have deviations that basically have never appeared before in history. Relative strength as they function is at the highest level on record, going back forever, going back to the 70s. So at some point, it's going to be an absolutely phenomenal short. And here's the important thing about that. Gold can have a 50% correction from here and still be in a bull market.
Mhm.
So,
Just
that's
like the S&P.
just like the S&P, right? I mean, so having a very substantial correction in gold is going to happen. You're going to need some catalyst to make that occur, whatever it is. But and when it happens, it'll happen very, very rapidly because that's how it's just historically happened with gold. When you see these big spikes in gold previously, they can run for a while, but when they break, they reverse almost the entirety of that spike very quickly. And it's very interesting because I talk to a lot of people every day, and I get all these emails like AI is in a bubble, and this is in a bubble, and that's in a bubble, but people that are long gold can't see that they're in a bubble. So it's but that's the way it is with all bubbles. If you're invested in it, you don't see bubbles until they're in hindsight. But you're seeing this kind of dynamic across the board. Take a look at small cap, mid cap, emerging markets, international markets, technology stocks, Mag 7 stocks, Bitcoin. Until recently, Bitcoin's been starting to reverse here lately. And even in precious metals, you've got this very similar vertical spikes going on in basically all these asset classes. And that's just a function that money is chasing money now. And you're seeing a lot of money just chasing momentum. So it's going up. So that drags more people into it. That drives the price up more, which drags more people into it. And it's very reminiscent of what we saw back in 1999. You'll probably remember this. Back in 1999, we opened up all those trading centers, and people would literally wait in line outside these trading centers to go in and trade stocks. And you're actually seeing that now with people lining up to go buy precious metals, outside of coin dealers, et cetera. You're seeing lines starting to form because
Yeah.
now after this
Outside the
move,
US, but yes, you're
yeah,
not
yeah.
seeing the US
But
yet, but
but
yeah.
but you're now starting to see that same type of mentality. Now retail investors are starting to pile into ETFs. They're kind of lining up outside the ETF store to buy the ETF when the market
Yep.
opens. But you're seeing that same type of psychological dynamic. And again, it's completely normal. That's what you would expect in a momentum chase. And this rally could continue for a while longer. Just be aware that eventually it's going to reverse.
Okay. And to the person who would say, no, Lance, it's different this time. And I know those are dangerous words, but there is truth in the debasement trade. This is really the world beginning to wake up to the fact that fiat currency is, getting abused by fiscal deficit spending and all that stuff. And this is
But, no,
really
but
let me just finish the question.
okay.
This is price discovery. This is the world waking up and saying gold was undervalued given that, and it's now rising more to its true value. What would you say?
Well, first of all, the debasement trade is not true on any front. So, there was a recent graph that was put out by statistics showing that gold reserves have now caught up with treasuries. And so central banks are accumulating gold hand over fist, which isn't really true. And we actually posted a chart of this on Twitter just this past week. Here, let me share this with you.
Yeah, but you're basically saying the rise there is more due to the dramatic increase in price in gold recently than it is them buying a ton more ounces.
Exactly. So if you look at this, so what this chart shows you is this is the chart of actual change in net purchases versus the actual change in gold price. So the change in gold price is orange. The blue is actually the accumulation of gold. Over the last 5 years, central banks have only increased their gold holdings by about 5% in total. So about 1% a year, which is what you would expect because simply they acquire gold to offset reserve currency differences. The US dollar currently is trading at the same level it was back in 1970. So if you look at a chart of the dollar index as an example, it basically either trades at a premium or a discount to 100. So we're trading at 98-ish right now. So we're just slightly below fair value for the dollar going back to 1970. So in that environment, because of that weakness in the dollar, you would expect to see them pick up some gold in terms of reserve currency balancing. Because again, the only reason that central banks acquire gold is to balance reserves against other countries, their currency versus other currencies, and their holdings versus other holdings. So again, they acquire that. The second argument is well, foreigners are dumping treasuries because they're trying to get out of the dollar. They want to own something else. Well, that really isn't true either. This is the foreign debt held by foreigners and international investors that just crossed over 9 trillion and is rising fairly sharply in the last year. So, all these narratives that have been put out by these people trying to, it's interesting. The people putting out these narratives are the people that are selling gold. Peter Schiff is a great example of this. He just posted a tweet the other day. He's like, hey, at the rate that gold's going up now, it's going to be 5,000 by the end of December. You should come buy some gold from me as a Christmas gift. Well, if gold's such a valuable asset, why are you selling the gold? Right? Why are the people promoting these narratives are the ones selling the gold to other people? So again, it's going up in price, but the narrative doesn't have any real foundation. Again, we've gone through the whole story about reserve currency balances before, the fact that, foreign central banks have, or, if you take a look at the US dollar, it's still 58% of all international trade. It's nearly 90% of all foreign currency transactions. Nobody's moving away from the dollar. And if you were going to move away from the dollar, where are you going to go? Right? You're going to go to the Chinese yuan. You're going to go to the Eurozone. The Euro is going to grow at 0.5% to 1% growth next year. You want to have money invested there versus the US that's going to grow at 2 to 3. So none of those narratives make any sense, but we need those rationalizations to justify paying higher prices for gold. It's the exact same thing that we do with the AI stocks, right? AI stocks are going off to the moon. Well, how do we justify that? Well, they're spending all this capex. So all these data centers are going to come online next year and they're going to create all this revenue and all this increase in productivity, which is going to justify the revenue and capex spend so we can overpay for those valuations today because the increase in productivity are going to boost earnings. Well, forget about the fact you're going to lay off half your workforce. And if you lay off half your workforce with AI, where your revenue is going to come from to justify those revenues, right? So, but we have to have those rationalizations to justify the price move. It doesn't, and this is what I said earlier, it doesn't really matter if those rationalizations are true or not. It's just whatever feeds the narrative. And this is why pay attention to gold prices, pay attention to stock prices, pay attention to Bitcoin prices. They will tell you when the run in that asset class is done and when you need to start, reversing your positioning.
Okay. All
And
right.
again, and just be full disclosure, right? We're very long gold in our AI model, in our all weather models. We're very, in fact, what's been a better performer in our precious metals models is uranium, which has kicked the crap out of gold over the last 2 months. But we don't talk about uranium, right? But we
Hey,
all
we
talk about
can.
gold because
Hey,
it's going
hey,
up.
like that's saying something because I
Yeah,
mean, gold has done phenomenally well.
yeah,
So,
and
yeah.
uranium's kicking its ass. So
Yeah.
yeah. And here's another problem with the whole debasement trade, Adam. Let me go back to this. Here's the problem with the whole debasement trade. So you know what this is, right?
I think I've seen it before.
Yeah, you think this is a dollar bill. So you can't debase fiat currency. This is the myth that everybody promotes. If I take this dollar bill and I tear the corner off of it, right? Will that dollar bill still buy me the same amount of goods?
I think until you get to enough point where someone's not going to take it.
Right. But the point is that I can so all debasement is removing the underlying asset that's within this, right? So if I have if I have a 25-cent coin, right, and I take the silver out of it and it's totally made by just copper, right? Let's just change all the quarters in the country to copper instead
Or
of
make
silver.
them plastic.
Make them plastic, right? As long as we say that plastic coin is still worth 25 cents, it'll still buy me 25 cents worth of goods, even though I have debased it, right? If I take a chunk, if I have a gold coin and I take one fifth of it out, right? So I have 1/5 less of gold in that coin. Well, that gold coin still worth the same as it was before I reduced the value of the gold in that coin?
No.
No, it's not. See, I can debase a gold coin because it's a commodity. I cannot debase a fiat currency because a fiat currency is simply just a value that we assign to a piece of paper. This is what we call currency, right? And for a currency to have value, we have to assign a value to it, and that is guaranteed by the government to have that value. Even though if I reduce if I debase this, so to speak, by reducing the paper content in it, it still buys me $1 worth of goods and services because this is the value that we have assigned to this dollar bill.
All
Now,
right. Okay, but I mean,
now,
the viewers are saying, well, what if you all of a sudden print up 1 trillion of those dollar bills tomorrow? Yes,
there's
it'll
still
buy a
there's still
dollar's worth of goods and services, but what a dollar's worth of goods and services will get you will be a tiny fraction of what it got you yesterday.
maybe, but that's called inflation, right? And so think about it this way. Tomorrow morning, let's say that we print up $1 trillion worth of these pieces of paper and we give them to every household. And just assume for a moment that everybody says, okay, everybody's got more dollars to spend, so I'm going to sell everything for the same price as I was. Just now everybody's got a lot of money to spend, so I can sell a lot of product. And so we'll just assume for a moment that prices don't change. So the only way that you can affect the purchase, and this is the argument, right? So it's just it's a misunderstanding of the word debasement that's being thrown around. What drives the value of the dollar in terms of its purchasing power parity, and that's all we're talking about, is inflation. That's all we're talking
Well,
about.
it's the classic Milton Friedman, right? It's always and
No, no,
everywhere.
no, 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 because everybody misquotes Milton Friedman, right? And they say, inflation is everywhere, blah, blah, blah. And it's only from the function of government printing, that's a very true statement. But what he's talking about is what happens over time. Now, this is the misnomer of debasement versus inflation. So again, I have this dollar. If I take this dollar and I stick it in my wallet and I never touch it for 10 years, in 10 years, this dollar bill will buy me less because the economy has grown over time. And because the economy has grown over time, I'm going to have higher prices. So I'm going to have inflation. We want inflation. We must have inflation to have economic growth. So this is why we want 2% inflation, because if we have 2% inflation, we have economic growth of 2%. We want that. We want that inflation. Now, what we don't want is 50% inflation, right? We don't want that. But if I just take my dollar and I do nothing with it, then yes, it's going to lose its purchasing power parity. But let's go back to 1970. if I took my dollar in 1970 and I invested it in gold, it's certainly worth more today than it was in 1970. But if I invested it in the S&P 500, it's worth about 10 times more than what I got invested in gold. So both of those assets protected me somewhat from inflation. It took gold 45 years to do that. The S&P outperformed that by massive extremes going back to 1970. So as long as I'm investing my dollars, then those dollars are adjusting for purchasing power parity over time. So I can defeat the deflationary impact of inflation or the debasement of inflation by investing it and not holding it in a jar underneath my bed, right?
Right.
So
And
that
we've
so
talked
it's
about
just
this.
it's
You want to invest it in things that will beat inflation, right?
well, or
And
at least
you
or
put up the
not
chart
even
of,
not even beat it, just keep up with it, right?
well, a couple of things. So I know you've
Yeah,
said as an investor, that is your job number one,
yeah.
which is at a minimum, I got to keep pace with inflation, right? So
Mhm.
I'm first and foremost, don't lose the wealth that I have purchasing power wise.
Correct.
Now, if possible, do
I want to
better
beat
than
it.
that, right? And you have pulled up the charts of the different asset classes, and
Yeah,
you've
yeah.
shown how stocks from certain periods have beat gold. Although I think gold has done pretty well versus stocks actually
And,
in the past couple of decades. Yeah.
yeah, no, no, yeah, absolutely. And again, so my point is, it
And
doesn't
Bitcoin's
matter.
done phenomenally well. Let's give a nod there too, right?
Yeah,
You
yeah,
buy
yeah. No,
Bitcoin at $20, you've
yeah,
crushed
absolutely.
inflation.
Yeah, no, no. My point is I'm not knocking any asset class, right? So it's just anything that will outperform the pace of inflation over time. And so this is the misnomer. This is where all the arguments fail. That, or these people run around going debasement, debasement. It's all about debasement. You can't debase a fiat currency. You can have inflation, but as long as you're investing your assets in something that outpaces or at least keeps pace with inflation, you're okay. It's just simply if you're holding cash and it's doing nothing, then you've got a problem of this loss of purchasing power over time. And that's all those charts that people show is like, oh, since 1970, the dollar's lost 80% of its purchasing power. That's a true statement only if you have held all your dollars since 1980 in a glass jar underneath your bed, right? As long as you invested it in something, some asset that outperformed inflation over time, then you're fine. And
Right.
that's
But
the whole reason why we invest.
right. But I just want to be really clear too.
Yeah.
This is a separate discussion, but this is why I'm so concerned about the wealth inequality that's going on because there's a bigger and bigger percentage of society that doesn't have extra scratch left over to invest. So all they're getting is the
Yeah.
inflation,
I
right?
actually just did a podcast yesterday with Ben Grand talking about the very same thing as the problem with, the problem that 80% of Americans have is very poor financial habits. And we've talked about this before, is that, we don't prioritize investing and saving. We prioritize spending. And that's what we've been taught by the media, by social media, by everything else. We're taught to spend everything we make. We've never really prioritized as a country that saving and investing is a far more important thing within our lives. And we wouldn't have this problem today if we had taught that. But we've taught ever since the early 1980s when we deregulated the central bank, deregulated the financial system, the banks itself. We went to this consumer overdrive. We created $11 trillion worth of debt between 1980 and 1990 by issuing everybody credit cards. That didn't exist. This wealth inequality gap and stuff didn't exist prior to 1980. And ever since that deregulation of the financial system, we have just indebted the average consumer to the point that they can't get ahead because we've never taught them financial responsibility. We've taught them to be consumers and good consumers, slave consumers. Get on that buy now, pay later thing because you can buy more. I remember, in late 1999, I was driving to work one day and Wells Fargo ran this commercial. It says, hey, you need to go to Disneyland this year. It's a magical place, but you can't afford it? It's okay. We've got a credit card for you. Put it on credit, charge it, take your family to Disney this year. It'll be a magic experience. And that's been the whole societal change, is that it's okay to have credit. And we push this whole narrative on people that, oh, you've got to have a credit card to have a credit score. Complete hogwash, right? But that was purveyed upon the average American as you've got to have a credit card. I want a credit score so I can afford to buy more stuff on debt. You don't need a credit card ever in your life, period, nothing. But we've taught everybody they need to do that. We taught people to buy houses that they couldn't afford. We've just done everything we can to destroy the bottom 80% of the economy by telling them to buy stuff they can't afford.
So I agree. We're in dangerous almost making this the rant territory, so I got to pull it. I got to pull it back. I will say though, just to underscore your point, I think this still happens because I've got kids and it's happened to them. But to your point, we started at a very early age, and I just remember going to college, and this was what 1990.
Yeah.
Um, Showed up on college, opened my student mailbox for the first time, and it was just jam packed with what? Credit card offers, right? Hey, you're young and dumb and you want to have some fun right now. Great. Don't worry about it. Just put it all in this brand new credit card we're giving you, right? I mean, they really try to get you very early on that whole treadmill. But
My dog, I had a dog when I was in college. My dog had an American Express card.
what? Because you gamed the system, or did it
No,
literally
no.
arrive in the
They
mail
sent
addressed
they
to
sent an
Rover
app.
Roberts?
Back in the day, remember they would send you the credit card in
Yeah.
the mail, and all you had to do was use it. And as soon as you used it, you were approved for credit, right? They sent my dog an American Express card in the mail.
Well, here's the question. Did he use it?
No, he didn't use it.
I would have liked to have seen the
I've
collection agent, what he would have done when he showed up.
I should have and go, hey, go collect from him. He's in the back.
Yeah, yeah. He's he's the snarling.
You go collect whatever he was a pit bull
Exactly.
too. So
He's
you go collect whatever you want from
yeah,
him.
he's the snarling Rottweiler. Good luck, buddy. All right. Well, look, just to your explanation there about the debasement trade. I understand your logic, Lance. I'm going to venture that not everybody listening, sees it the same way, and that's okay. That's what makes a market. As somebody who is, an owner of precious metals and has been loving the ride, I'm just going to reiterate.
Absolutely. Us too.
You too. I'm just going to, say, hey, look, even if you disagree with Lance, you should ask yourself. Well, let me just put it this way. I've been counseling people to think about at least hedging their positions if they don't want to take some gains, and we've already talked about this. But it has risen so far at this point that this is now a windfall. It might have been the windfall that you expected. I was sure this was going to happen someday, but the windfall, you are now at windfall levels. So you got to ask yourself, all right, look, if it didn't go up any higher, right? And my holdings are as much as they are today. My life has changed in some material way. That's great. But then ask yourself, okay, what would happen if this got pulled away from me, right? If Lance is right, even though I don't necessarily agree with him, but technically it's a big pullback, or just, hey, Lance was right. This thing turned out to be a big bubble spike, just like we saw in 2011, right? Where, there was a violent correction and then the precious metals kind of stayed dead for a decade plus. So my point is you've got a windfall right now. As a steward of your wealth, you've got some decisions to make. How do I want to protect that, right? And some people are going to say, Adam, don't worry. I think this thing's going much higher. Great. I hope it does.
It very well could.
Yeah. But I'm just saying what I want to do is minimize the amount of people who, if indeed lower prices manifest from here, say, oh my God, I had the brass ring for a moment and I let it go, or I had the gold ring for a moment and I let it go. So only you can determine what kind of risk you're willing to take on this. But you've had your prayers answered at this point as a precious metals holder. Ask yourself how I want to make sure I protect what I have, and still maybe position myself to participate if things go higher from here.
Yeah. And look,
All right.
I think that's a wonderfully great point, and this is the thing that, just to your point to think about is that a lot of the people that have owned gold, they've owned it for a long time, and they went through a very long period of just owning dead money essentially. And now you've gotten that money back, you've made a profit, and just realize that gold does historically, going back to 1980, I mean, it went through almost 20 years where it just did nothing for a very long time. And then you had a spike in gold, and then it crashed, and you went through a very long period. It did nothing. That's the normal history for gold. So just understand that at some point this rally will be over, and then gold maybe do nothing for 5 or 10 years before it has its next rally. And but during that time frame, you're going to start losing to inflation again over time. And again, what we want to do is make sure our assets are always working relative to inflation. So again, it doesn't mean there's anything wrong with gold. There's nothing wrong with gold right now. Momentum is very strong. Bullish sentiment strong. You've got all these narratives running around. And again, if you disagree with me on the facts, which I just showed you the facts about what's really going on, there is no debasement trade happening. If the debasement trade was happening, yields wouldn't be falling right now on bonds. So there's another problem with that whole argument. But even if you disagree with that and you're convinced that so-and-so told you the debasement trade's happening and you absolutely 100% believe that, that's fine. Just understand that there are consequences to that as well. And those will have an impact on future values of money also if that occurs. And so just make sure that you're managing that risk accordingly. Just again, we're long the assets now. We'll eventually take profits, reduce risk. At some point, this will be a fantastic short. All these type of moves are. It's just a function of question of time. It could be next year. It could be a year after from now. It could be $1,000 higher from here. But just understand that risk is very prevalent.
All right. And just on that point, you say, hey, look, the market hopefully is going to give us warning signs when there's going to be a big turn. You're not seeing enough warning signs around gold and silver right now for you to be lightening up on your positions in your all-weather portfolio.
Well, no, we've already we actually rebalanced gold. What is today? Friday? Wednesday. So we trimmed gold a little bit in our portfolio on Wednesday.
Okay, so you trim gold a little bit, but you're not the like, hey, I'm seeing those signs.
Oh, no, not at all. But here, let me share a chart with you real quick. This is the stuff you don't see very often, right? So this is a chart of gold prices, and this goes back. This is to 2016. I can make this a little bit further here. Hold on, let's back up. So you can, let me zoom in. I'm going to zoom in, zoom out real quick. Do you see this spike right here on both on this right-hand chart, and see this RSI up here? This is relative strength up top.
Yep.
So this is a weekly chart. This is a weekly chart. So this is the 12-week moving average. I'm going to jump this out to monthly just to give you a better picture. Okay.
Okay. Yeah. So, but the needle is pinned to 11 is essentially what you're saying.
Right. Right. So relative strength relative to its 12-month moving average is at 93. Right. RSI only goes to 100. This is the highest level of RSI reading ever on record. Now, the reason that's important is if you look at every period previously to where RSI was up these levels, gold and these are not minor corrections. This was about 20% right here. This was about a 45% correction here. Whenever gold gets to these extreme overbought conditions, you at least have a pullback. You can have a subsequent rally and then another correction. And this happens over and over and over again. But importantly, we've never had deviations from the 4-year moving average. This is the highest level on record right now ever for the deviation from the 4-year moving average. So again, just reversions to the mean at this point would take gold back to the 4-year moving average, which is the orange line. That's around 23.12 on gold right now. So you're talking roughly about a $2,000 drop on gold. And everybody's going to go, oh, that's not possible. That can't happen. It happens with regularity with gold, going back to and beyond its 4-year moving average. That's a normal correction for gold. Here, back to the 4-year moving average. Here, well beyond the 4-year average. Here, well beyond the 4-year average. And this just goes back throughout history. You just continue to see the same thing. So the important point is don't, the technicals right now, very bullish, lots of momentum. That's what all those things are telling you, but it's also getting so deviated that the gravitational pull against that price is becoming very strong. And at some point, the only thing that drives gold prices higher, along with silver, because silver and gold don't have any fundamentals. So what drives the price of gold? It's buyers versus sellers. So you have an overwhelming demand of buyers right now versus those willing to sell. I'm not willing to sell my gold right now. So that's going to require buyers to pay a higher price. So that's dragging sellers into the market. Because remember, got to have a buyer and a seller for every transaction. So every time something happens, it's dragging a seller higher in price to sell it. But at some point, somebody in the commodity exchange on NYMEX goes, you know what? This is ridiculous. I'm out. He's out. The next guy goes, oh, Jim got out. I'm out too. And then it all comes into trading places where everybody's screaming at one time in the pits to sell. And that's why you get these very sharp corrections in commodity prices that can happen literally overnight. I mean, like one morning you'll wake up, you'll be down 4 or 5% in gold. And that'll be your signal that the reversal has started.
Yeah. Okay. All right. Well, look, let's move on here. There's another commodity I want to talk with you about, Lance, not now, but in the future. I talked a little bit about it with Michael last week, but is oil. Oil is one where the narrative has really been working against it
Mhm.
And yet it's a critical world commodity, and demand for oil is likely to continue to rise from here. And it's a cyclical industry. It's in a bust right now. It's a boom bust industry. It's in the bust
Right.
right now. When does it make sense to start preparing for the boom? I want to give you
Yeah.
plenty of time you said now?
Yeah.
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 Okay.
We're actually starting to accumulate positions in oil because again, this is also another argument against the debasement trade, which is oil prices.
All right. And give me
Um,
just a super short answer because I actually want to do a deep dive with you on
yeah, no,
this.
we'll do a deep dive in it. But no, there's some things that are happening that are going to be very beneficial for oil prices as we go into the next year and year after. And this is particularly relates to this idea that we're going to have a rebound in economic activity driven by this AI capex spending, this trillions of dollars that everybody's supposed to spend. If that occurs, that's going to drive an economic rebound, and that should provide a very good tailwind for oil because of the demand structure for economic growth and oil and energy demand in general. And a lot of energy demand will be driven by natural gas, which is produced by companies like ExxonMobil, Schlumberger, et cetera.
Yep. Okay, great. We'll get into that. You also raised a point too that, again, we'll get into later in more depth. Um, my opinion, one man's opinion, like them or not, the economic policies of the new administration are intended to spur economic growth,
Mhm.
deregulation, tax relief, pulling foreign capital into the US, all this type of stuff, right? And just like QE, just like checks to households, whether you like those things or not, they stimulate the economy, right?
Yep.
So, uh, you know, now that the administration has been able to pass the OBB and get a lot of this stuff put into policy and whatnot, and the clock is ticking on this stuff now, we are likely to start to see some tailwinds to the economy from that next year. And again, I'm not saying you have to like them or approve of them or whatever, but to ignore them, I think, is dangerous. Now, there may be some other factors that might be providing headwinds at in parallel in these things. But my point is that all things being equal, we should start to see tailwinds to the economy from these policies as we go further into 2026. And again, that'll, stimulate the economy, but also stimulate demand for things like oil, correct?
Yeah, absolutely. And again, this is all kind of hope. Right now we're certainly seeing, still signs of economic weakness. Employment numbers haven't been great. Philly Fed came in yet. We're lacking a lot of data right now from the government because of the
Yep.
shutdown. But like the Philly Fed came in yesterday, -12, much weaker than I expected. The employment side of that report was not great. So we're still seeing that economic weakness, and that's still my concern going into next year for the market overall, which is earnings expectations are very elevated relative to what we're seeing in terms of economic activity. So the whole bet is that we're going to see this economic resurgence next year because of all this capex that's getting spent into build out. And assuming that capex comes true, we should see a pickup in economic activity next year. But there's a lot of ifs in there. So
Right. And it doesn't mean we couldn't see both, right? We couldn't see a really weak half of the first half of the year and then a stronger
yeah,
second half.
yeah. So for us, just managing the portfolio, we're certainly looking for opportunities that are undervalued and out of favor. Energy fits right into that category. And pay good dividends, great fundamentals in a lot of cases. But we haven't seen that actual start to turn yet. So we need to be aware of that potential risk going into next year because again, there's such a gap right now in narratives. And again, we just kind of went through the narratives with gold, and there's a big gap there between the fundamentals and reality. Same thing occurs on the AI side. There's a huge gap between expectations of what AI is going to generate and the reality of what will probably happen. And this was a conversation that Ben Grant and I had a conversation about yesterday, talking about because he came up through the dot-com bubble as well. And during the dot-com bubble, really what caused that problem is, look, the internet made us hugely productive, right? We use the internet for everything. We're using the internet right now, right? There was all this build out. Remember, there was all that capex for building out fiber optic cable. We had all this capacity of cable and nobody could use it. And then this little company called Google comes along in 2005 and says, "Hey, we've got this idea for YouTube that can use this fiber optic cable." Well, the reality of the internet came. It just came 5 years later. And so all those expectations for revenue growth fell well short. It wasn't that they weren't real. It just took too long to get there. And that's my kind of concern with this whole AI, kind of space in the markets, is that the productivity increases, the applications, all those type of things may be very real. And but if there's a gap between expectations and when it occurs, so let's just say it takes a year longer to get there, all of a sudden those valuations that we're paying for a lot of these stocks becomes very problematic, especially for companies like Oklo, which is the nuclear power company.
Yep.
They have no sales. This company has zero sales. They have no revenue at all. It's all based upon the expectation that at some point they're going to build a power plant. Could be very well the case, but what if that power plant comes a year or 2 or 3 later than what's currently expected to happen? What if there's some delay in that? You could see very, very big price declines in some of these companies. Again, they won't go bankrupt, but you could lose a lot of money between expectations and reality. And that's the thing I'm really worried about next year.
Okay. Well, yeah, I've got similar concerns. I still am in my camp, and again, one man's opinion, of being short-term more bearish, mid-term more bullish, and then long-term more bearish again. And with that I've got a lot of concerns about the speculation that's been driving asset prices that you and I talk about all the time.
Yeah.
That's exactly what you're just talking about there. So if those assumptions get challenged by reality in some way, I could see a big notable correction in asset prices.
Yeah, and that's my, just from portfolio management side, that's my big concern going into next year. Next couple of months, there's too much momentum, too much bullish.
Probably party on with Santa Claus rally.
Yeah, exactly. Well, it's hard to break momentum, right? There's so much psychology. Again, going back, doesn't matter what asset class you own. If it's doing well, there's a lot of faith in that, right? Gold's going to go to the moon, stocks are going to go to the moon, the small caps are going to go to the moon. Whoever you talk to, whatever asset class they own, is like, oh, this time's different. It's going up to the eons here because of whatever reason. Well, we know that's not true, and that'll never happen. But that's a very hard cycle to break. It's hard to stop that momentum train, as we talked about, a couple of shows ago. It's like, it's just so much. There's so many cars pushing the engine right now. It's hard to bring that to a halt. Eventually that'll happen, but again, it's not going to happen in 2 months. That's why I'm not really worried about between now and the end of the year. My worry is more kind of summer-ish next year, I think.
Sure, yeah. Well, and who knows, but you'll be looking, at the technicals and looking for those warning signs. But if that happens, corrections, corrections tend to be faster events than long-term bull rallies. So we'll have that correction, and then presumably, and of course, reserve the right to change my opinion as we have more data in the future, but presumably we're going to start getting those tailwinds from the economic policies that are being put in place now. And to your point, we should start seeing, to the extent there is any there in AI, we should start seeing corporate America actually start to see incremental revenue and profits by deploying that, right? So,
and hopefully we can buy those assets at better prices.
Well, exactly. That is the silver lining here, pardon the pun, but if you're correct and there is weakness here in the next 6 months or whatever, if you can manage to keep your capital dry through it, you might be able to get some phenomenal entry points.
Yeah, absolutely. And
to this point of next year, or next video, oil may be giving us some great entry points now.
Right, exactly. Well, and that's the whole point about investing is that when do you want to buy an asset? When it's, like for instance, if you had 100% cash today, what would you buy today? Would you buy gold, AI stocks, or energy stocks that have been beat to shit? All right. There's the whole purpose of investing is to buy something that really kind of nobody else wants, but has value.
Right. And just to be clear, a lot of gold owners right now felt like they did exactly that 5-10 years ago.
Yeah,
hey, this thing's out of favor. I see the long-term potential. I'm buying it at a discount.
And they have done fantastic. Now, just don't forget to execute the other side of the trade, which is to take the profits.
Yep.
Right. But again, as investors, we want to try to, we don't do this as investors, right? As investors, we just buy whatever's going up at the time. And this is why investors always buy high and sell low. But yeah, our job is to try, and this is why, through SimpleVisor, I've talked about before in SimpleVisor, we go through, look at the distribution of sectors or factors and, if they're overbought or oversold. And with regularity, we'll say, hey, look, healthcare is really out of favor right now. And then healthcare has a boomer run. And that's because money's going to rotate within the market. Money, as we talked about before, money never leaves the market. It just changes form. So, right now it's going into some assets. That's where it's going. Eventually it'll leave that asset and it'll go into another asset. But money doesn't get destroyed. Even in the Bitcoin wipeout last Friday, everybody's like, oh, $28 billion or whatever it was got liquidated out of the markets. Well, it didn't liquidate out of the market. It went from the people that were long Bitcoin to the people that were short Bitcoin. And
Yeah.
money changed hands. So, but
Yeah.
that's how markets work. And so, I mean, just money's like energy. It doesn't get destroyed. It just changes form.
So I agree with money, and sorry, I might be getting a little too stuck in the weeds here,
Mhm.
but there is something called what I call money heaven. Maybe we want to call it market value heaven, which
If you're talking
is,
about heaven, yes.
yeah, yeah. So, everything changed at the margin, right? So if Bitcoin was trading for 120 and then the next transaction it trades at 100, you actually had a lot of market value that literally went to market value heaven. It wasn't money that all went into somebody's account, right?
Well, no,
So
it did. It did. It went from the guy that sold it to the guy that shorted it. So, because whoever was short that same value increased the same amount of value as the market value dropped in the
mm,
asset, right?
no,
So
is there always a one-to-one? I don't necessarily think so. I
there was
get
a
it,
there was
but
there was a lot of short positions out of there. But
yeah,
yes, and when you're talking specific, no, again, we're talking about two different things, right? We're talking about money, and we're talking about
that's why I said maybe
right,
it's more accurate to say market value heaven,
yeah,
but
which
yeah,
is right, which is yeah, you lost a lot of market value, but the money itself simply moved from those hands to somebody else's hands.
yeah.
So somebody owns it somewhere.
Okay. All right. Uh, I got to wrap it up here. I got to prepare for the conference, which I'm super excited for, folks. But yeah, a lot of wood to chop. Real quick, you mentioned this super briefly, but the 10-year has been coming down. The day we're talking, I think it's right at 4, and I did see it actually slightly below 4.
Yeah, we were
Um,
at 375 yesterday.
Yesterday. Okay, yeah. So are you seeing this as the start of perhaps of a breakout to the downside where we start to get a three handle on the Treasury?
Yeah, it's looking a lot better. I was actually posted a chart today in our daily market commentary. Let me see if I can find it here real quick. Bear with me one sec.
Okay. While you're looking to pull it up, one thing I'd love for you to talk to in the context of whatever your answer is going to be is so we may, I mean, who knows, but we may have US 10-year yields finally starting to come down. At the same time, we are seeing credit spreads start to finally increase.
Yep.
So if you can just take your perspective, share your perspective on both sides of that with us.
Yeah, yeah, no problem. So this is today's daily market commentary. We talked a little bit about the SOFR issue, right? This goes back to that liquidity warning. This is a really good read. Mike wrote this first part about liquidity warnings. He ran a piece on overnight liquidity, looking at that data. So you're certainly seeing some stress in the credit market. But this was the chart of the 10-year Treasury. So so this is the interest rate, right? So this is the yield on 10-year Treasuries. This is not the bond price. Um, the upper band up here is basically overbought and oversold. So when interest rates get really overbought or conversely very oversold, and remember, interest rates are the inverse of bonds. So if interest rates are overbought, bonds are oversold, that type of thing. The bottom is basically your buy sell signal for bonds, and you can see how deviated that this signal got from kind of previous extremes because of this run up. But we formed a very nice wedge pattern technically in the 10-year Treasury, and we're just now starting to break to the bottom side of that wedge. So this has been a very nice consolidation pattern after this big run up in yields, and this suggests a lower yield. So if we break here, which again, this is a monthly chart, so it's a little bit slow to move, but we're still very overbought technically. We're still very overbought on a MACD basis. So a break lower here, just to return to normality, would put us back into probably the 3% range, maybe the 275 range on the 10-year Treasury before that reversal is complete.
Okay. Wow. So maybe even a two handle at some point here.
But now to have that, you're going to need slower economic growth, decline in inflation, which we'll see that. But economic growth getting closer to 2% than 3%. So there's some things that are going to kind of dovetail with that. accordingly. But again, just technically, that's kind of what it's telling you. And again, kind of going back historically, you can see that when interest rates have peaked and turned lower from these signals, you have decent downturns in yield. So technically, we're lining up with what has historically been a fairly decent opportunity to be long yields.
Okay. All right. Well, we'll keep our eye on that. And then
Oh,
credit
well, you
spreads.
asked about credit spreads real quick. Um, so yeah, credit spreads, yeah, they've ticked up a smidge, but this is double B junk relative to treasuries. They have ticked up a little bit, but not dramatically yet. So you are starting to see a little bit of stress in the credit markets, but it's not going bonkers just yet. We're not seeing these type of activities. This was back in early 2020. This was during the credit shutdown. Over here was the Silicon Valley bank crisis. So you're not seeing those type of moves in credit yet, but you are starting to see little upticks.
Okay. So right now, I guess it's just something you're kind of keeping half an eye
Yeah, yeah,
on, but
absolutely. And you're seeing it more if you get more into stress, like C credit, you're seeing a little bit bigger uptick, but again, they're still very minor.
okay. Yeah.
So,
I mean, I was looking at, I think high yield when I last looked at this, and it was definitely, you could finally notice a difference.
yeah, you can. I mean, if you zoom in on this, you can definitely see a little bit more of an uptick, but you got to keep it to perspective. Just having an uptick is one thing, but you need to see a sustained kind of increase in yields to start saying, hey, there's something really starting to impact the credit markets.
Yeah. Well, okay. We'll keep our eye on this,
Yeah,
but
yeah.
I think what's notable about it is the trajectory for a good long time has been down to flat,
Yeah.
right? So the
Well, it's
fact
been
that,
good for markets,
yeah,
right?
right. Meaning if this starts picking up again, that might be yet another near-term headwind for markets, but we'll
Absolutely.
keep our eye on it.
No,
All right.
and real quick, just finish that thought. I told you
Yeah.
before that the only thing that matters is credit spreads. And that still remains a very true statement. That's why we watch credit. That's why we track credit spreads on SimpleVisor. That's why we talk about it so much in our own work. That if you want to know if there's a risk event coming to the markets, credit spreads will tell you. Everything
Okay.
else doesn't really matter.
Yeah.
But
They're kind of the barometer of people's the big money's nervousness.
exactly.
Yeah. Okay. I wanted to talk a little bit about what's going on with Bitcoin. We'll save that for next time. So as we wrap up here, trades. You guys made many trades over the past week?
Not in the last few days because we did them previously to this week. We as we talked about previously, we were kind of getting worried about this extension in the market, so we went through and rebalanced all of our accounts, the thematic models as well as our primary accounts. We actually had to rebalance the small and mid cap model 3 times in the course of about 2 weeks because certain positions in those were going up like 50% a day. So it was just kind of bonkers what was happening in the small cap side. But yeah, we went through and just in like the all-weather model, like I said earlier, we rebalanced our precious metal positions there just to bring them back down to more reasonable target weights. We're still about long, and then in those portfolios, we're still long about 17 to 18% precious metals in those accounts. So there's a lot of exposure there. In the crypto model and AI models, we've had to rebalance those a couple of times. Those have been there's certain positions in there that have just gone up dramatically in a very short period of time. That's just all that speculative push
Yep.
we're seeing through those models. So again, we've had to do a lot of work previous to the end of the month, and all worked out well because we rebalanced that before we took that big hit in the market. So the timing of it worked out really well for us to kind of be realizing that we were getting extended and saying, hey, we should probably pull some risk off the table, and that timing just happened to work out well.
Okay.
So
Um,
better to be lucky than smart, right?
better to be lucky than smart. All right. So we'll start landing the plane here. I'm not going to do a big rant this week, but Lance, I did a little bit of discussion with Stephanie Pomboy this week about my move to Nevada and some of the initial my initial reactions to having been here now for a while. Um, and it's been great. I got a little story I'm going to tell you in just a second, but I moved here primarily for the state income tax savings because California is the highest in the country at 14.4%, the high end. Uh, Nevada is 0%, which is I'm hoping going to be wonderful. I haven't had to pay my taxes yet. I'm not going to do that until the spring. but I'm hoping to really enjoy it. And Lance, you're a fellow 0% state income tax guy. So I want to hear, if that's really worked out as well for you as I'm hoping it's going to work out for me. But I've really enjoyed the transition, and at some point I'll wax more lengthy about exactly what I'm really liking here. But again, I moved really for kind of a pedestrian or just an empirical reason around taxes and cost of living. But I've really enjoyed what Reno, which is where we live, has to offer, and even more than that, I'm realizing just kind of having a new life adventure, right? Just mixing things up in life, changing things. I've lived in California now, when I think about it, like over 25 years. Right? It's a long time to be in any one particular region. And there's a lot of things about California that are phenomenal, especially in terms of the natural beauty and what you can do there. And let me tell you, as it's getting colder here, there are certain things that I miss there. But there's an old speech, and I think it's apocryphally attributed to Kurt Vonnegut, but I don't think that's true. But in it, he says, everybody should live for a couple years in New York, but leave it before it makes you too hard. And everybody should live a few years in California, but leave it before it makes you too soft, right? And again, I just spent 2.5 decades in California, and I'm just finding that, yeah, just kind of the change of life, change of scenery, mixing it all up. There's a lot of just goodness that comes from that. You kind of look at the world with a fresh pair of eyes. You get exposed to new things that when you were in your routine where you were before, you just missed, or you had tunnel vision on because you were in your routine. So anyways, I'm not advocating everybody just, ditch where they live and move somewhere else real quick, but kind of breaking out of your routine, putting yourselves into kind of, new environments, even if it's not necessarily something you feel like you're craving right now. There's a lot of benefits you get from it that I just wasn't accounting for. And so I'm really enjoying that part. Now, fun little anecdote. And maybe, Lance, there's a signal in here for the markets, but my wife took the dogs for a walk yesterday, and she was walking by a house that was under construction. And right by the house was a pickup truck that the workers there had parked. And she's walking by with the dogs, and she looks, and she all of a sudden realizes, oh my God, there's a bear in there. And the bear was eating the lunch of one of the workers, and the workers hadn't noticed it yet. So, her thing was trying to get the dogs away before the dogs saw the bear and started freaking out. And maybe the bear decided the dogs would be a better lunch, right?
Yeah.
But I shared that story on X, and one of it was I was just sort of tongue in cheek. Hey, this is the adventures of living in a new place where you're not quite used to what goes on there. But a lot of people were saying, well, hey, maybe that's a sign that the bears are finally coming back out, right? So, anyways, we're having all sorts of new experiences and adventures like that one here. But in wrapping up, Lance, like I said, I haven't had to pay taxes yet, but I am looking forward to the savings that'll come along with moving here. You've been in Texas for a long time.
So you're renting now though, right? You haven't bought yet?
We haven't bought yet because we wanted to make sure that the move was a good one, and we don't know Nevada enough yet to know if indeed this is where we
Yeah,
want to,
no, I
like,
get that. I get that. So in Texas, we have zero income tax in Texas, like you do now.
Right.
But they get us on property taxes. So
That's sort of what I
and
hear.
so,
Yeah.
that's about 8.5% ish. So, depending on where you live. But so I guess you have to really kind of check. I don't know what property taxes are in California, in Nevada, but that's my theory is that no matter what state you live in, they're going to get you somewhere. So, you know, but it's definitely going to be better, regardless of what the property taxes are in Nevada. It'll still be better than your tax rate in California. So you're going to be in a surplus, however you turn out.
Yeah, it's interesting, and maybe native Nevadans can comment here if they're watching. I just did a quick search, and it says while Nevada doesn't have a single statewide property tax rate, its average effective property tax rate is one of the lowest in the
There
country.
you go.
So hopefully that'll be great
Is
when
there
we
is there
go
a
to
house
buy.
next to you that I can move into?
Yeah, we'll see. I love our friendship, Lance. I'm not sure if the house next
Oh, you
door
coward.
is the right choice. But you know what? Look,
Actually, it would completely work, Adam, because I'm a hermit. So I never leave my house. I hate leaving my house. I hate people. So, I would never see you anyway. I could live right next to you. I'd never
well,
see you except on
and I've
Friday.
met your wife, and she's wonderful. And also, too, like if we're worried about things getting, really bad in the future, you're the guy I want to live next to who's got all the guns and the training and the martial arts capabilities. So, all right,
Oh,
maybe we will do that. But anyways, yeah. So we'll see where all this ends. But I got to say, just high level, um, it's sort of an accidental adventure, right? We made this decision purely around the money side of things, and we're actually finding, hey, there's a lot of fun in just kind of learning about a new place.
dude, I think I love Nevada. I've spent a lot of time there, so it's a great state and it's a beautiful country. So I am thrilled for you. I think you're going to enjoy it. I think you're going to find out that you probably even like it more than California at the end of the day, just for a whole variety of reasons.
We very well may, and again, there's some parts of California that are just absolutely uncontestable. Whether it's Yosemite, whether it's the Pacific Coast. I mean, there's just so many beautiful areas. But the thing is I can still drive to them. They're in driving distance from here, right? And if I get sick of the snow, yeah, I can drive to 75-degree weather, whenever I want. My wife's family's still back there, so.
Yeah.
We'll see. And again, I'm not trying to make this about me, although I have told folks that I will do kind of a deeper dive video on kind of the math behind the move, the reasons behind it, and then what I had to do to sever all the ties to California so that California will stop considering me a resident and wanting to tax me. It's not that easy.
That's
Anyways,
interesting.
for the folks who have asked, I'll go through all that. But again, not trying to
I
make
would
it
be
all
interested.
about me.
Yeah, I'd be interested in hearing about that. Like, okay, I've decided to leave the state. Yeah, but we're going to keep taxing you anyway.
Yeah, I mean,
That's amazing to me.
so it's funny. I walk around here, and especially in the area I live in. I mean, 5 out of every 6 people I've met so far are California refugees,
Yeah.
who just wised up earlier than I did. But a number of them have war stories of like, oh yeah, God, no, it took way longer than I had, imagined to be able to cut those ties, and I ended up sort of settling with the state for X or whatever. I think it's harder if you have property still in the state, right? And I think it's also harder too if your employer is a California employer, but you're working for them, in a different state,
Interesting.
right? The fortunate thing for my wife and I is we're self-employed, and we don't own any property there, so a little
Yeah.
bit cleaner. Yeah,
Awesome.
but you got to do all sorts of things in terms of, registering to vote and changing your bank accounts and signing up for civic organizations to just show that you're committing to the location and not planning on going back. It's just crazy. But anyways, all right. Well, look, Lance, great week. You're going to be off next week because that's
Okay.
another chemo week for your wife.
Yep.
Hope
Number
things
three.
continue to go
Number
very well
three.
for her. And actually, for the folks asking, how's she doing?
She's doing great. I mean, we're going, just going through the process. So next Friday is week number 3. So it'll be her third treatment, or sorry, treatment number 3. So we're halfway home. So kind of getting to see the other side of the cliff here. But overall, she's honestly she's doing really well. The first few days after chemo are pretty rough, but she recovers, gets her energy back. She's traveling this week on business. So again, she's doing amazingly well. We got a blood test back. It's called the CA 125. And when she was first diagnosed, that blood test was registering around 130, that suggests you have cancer. If you're above 30 is that number. And we got that blood test back last week. It was at 15. So it's had a huge drop. So that was really good news. That means the chemo is working like it's supposed to. So very optimistic, fingers crossed. And listen, I can't tell y'all how much that she and I both appreciate all the prayers, the warm wishes, the advice that everybody sends me. I heard this doctor and I heard that doctor. We take it all in, and we appreciate it very much. And it's been overwhelming how much support that she's had, and it's been great for her and really helping keep her kind of. It's very easy to slip to the kind of the dark side when you're dealing with cancer. But all the support has been really helping her remain optimistic. So thank y'all for that.
All right. Well, that's wonderful, especially the test results there, and yeah, the goodwill, the prayers. And I'm sure even all the articles of the next breakthrough,
Yeah.
medical thing around cancer, those are all going to continue, Lance.
Oh,
So,
I know. And again, we take them all to our doctor and we say, we got this. What do you think? And she says, she gives us her opinion, and then we work with it from there. So, it's great though. But I don't discourage you. I try to answer all the emails. If you've sent me an email and I didn't respond to you, I'm sorry. There's been a lot, but I try to answer every one of them.
I think folks understand. I'll just also say too, Lance, I was actually in Texas briefly last weekend, and reunited with my buddy who had brain cancer. I told you about it. He was sort of riddled with cancer. That's probably about 5 years ago, and went to MD Anderson, and he is going strong now. He's been in remission for a couple of years now, but just hopefully that's one more data point that gives a little bit of
Yeah.
hope that, hey, that guy's come through real well, and certainly hope your wife does the same or better. All right, folks. Well, look, in wrapping up, as usual, please show your support for Lance. Do that today by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. A reminder, if you want to watch the replay of the conference, which has been going on in parallel with this as Lance and I, or as this video has premiered, then just go to thoughtfulmoney.com/conference, and you can buy the replay videos there. And if you're a subscriber, a premium subscriber to our Substack, you can still use that code I've been sending you to get $50 off the price of the replay videos. And then last, if you'd like to get some help in managing your portfolio for the road ahead, especially if it potentially takes the trajectory that Lance thinks it might take from here, highly recommend that you get that guidance from a good professional financial advisor who takes into account all the issues that Lance and I have talked about here and that many of the guests and I talk about on this channel. If you've got a good one, well, don't mess with success. But if you don't, or you'd like a second opinion from when it does meet those criteria, maybe even Lance and his team there at RIA, then fill out the very short form at thoughtfulmoney.com to have a discussion with them. As soon as you fill out the form, the firms will be in touch with you right away to set up that discussion. All right, Lance. Wish you all the best next week. We'll have Michael here sitting in your stead, and then we'll see you back 2 weeks after that, and we'll do our deep dive on oil.
Sounds good. Looking forward to it.
All right, everybody else, thanks so much for watching.